So today we're going to tackle a really huge shift in the world of accounting, IFRS 16. And look, this standard didn't just tweak the rules a little bit. Oh no, it completely changed how companies have to report the things they use but don't actually own. We're talking about bringing trillions of dollars of obligations out of the shadows and right onto the balance sheet for everyone to see.
Okay, let me ask you this. Just think about it. What if a company's biggest, most significant debts were completely invisible? Imagine a major airline, right? It's got hundreds of planes. But what if the massive long-term commitment to pay for all of them just didn't show up on their financial statements? For a really long time, that wasn't just possible, it was totally normal. And that was the core problem. Companies could sign these massive multi-year deals for things they absolutely needed to run their business, airplanes, retail stores, giant office buildings, and those huge obligations wouldn't show up as debt. This made it incredibly difficult, almost impossible, for investors and analysts to see how much risk a company was really carrying. So here's how we're going to break this all down. We'll start with that old world of hidden debt. Then we'll dive into the big change, IFRS 16 itself. After that, we'll get into the nitty-gritty. How do you even know if you have a lease? What's the impact on the company using the asset? That's the lessee. And what about the owner, the lessor? And finally, we'll tie it all together and see why this standard really matters. All right, let's set the scene. Before IFRS 16 stormed in and changed everything, the world of lease accounting was basically split right down the middle. You see, most leases were called operating leases, and that was the magic trick. The payments were just treated like any other monthly bill, like a rental expense on the income statement. That long-term promise to keep paying for years and years, poof, nowhere to be seen on the balance sheet. Maybe you'd find a little note about it buried deep in the footnotes if you were lucky. So the whole goal of this new standard was to move from this murky, opaque world where you had to be a detective to find the real numbers to a system where the financial reality is clear, it's comparable, and it's sitting right there on the main financial statements.
And that brings us right to the solution, IFRS 16. This was the accounting world's big answer to that whole problem of off-balance sheet debt.
So here's the absolute heart of it. IFRS 16 basically says, hey, if you have a contract that gives you the right to control an asset for a period of time, you have to put that on your balance sheet. It's that simple. For the company leasing the item, that old distinction between operating and finance leases, it's gone.
And wow, this slide just lays it out perfectly, doesn't it? On the left, you've got the old world, just an expense. But after IFRS 16, bam, it explodes into two new things on your balance sheet. You get an asset, which is your right to use the thing you're leasing, and you get a liability, which is your obligation to pay for it.
Okay, but hold on. Before you can do all this new accounting, you have to figure out if you even have a lease under the new, much stricter definition. And IFRS 16 gives us a very clear roadmap for that.
The standard gives us this decision tree. Now, I know, it looks a little complicated, but it's really just designed to walk you through a series of questions. The whole point is to figure out if a contract is a lease or even just contains a lease. And as we're about to see, it all comes down to one word: control.
And honestly, you can boil that whole complicated flowchart down to three key tests. It's like a simple checklist. First, is there a specific identified asset? You can't just lease a car, it has to be that car. Second, do you get pretty much all the money or benefits from using it? And third, and this is the big one, do you get to decide how and for what purpose that asset is used? If the answer is yes, yes, and yes, you've got a lease.
Okay, let's zoom in on the lessee. That's the company actually using the asset. Because this, my friends, is where the revolution really happened.
For lessees, life got simpler in one major way. Almost every single lease is now treated exactly the same. This single model means that whether you're leasing a whole fleet of trucks or just one floor of an office building, the accounting logic is the same.
So on day one of the lease, the company makes this journal entry. They get a brand new right of use asset on their books. That's the right to use the item. And on the other side, they record a lease liability. Now, this liability is just the present value of all the future lease payments, which is a fancy way of saying what that future stream of cash is worth in today's money. The result? Suddenly, both the asset and the liability sides of the balance sheet get a whole lot bigger.
Now, the standard is practical. It's not totally crazy. It gives you two key escape hatches to avoid pointless paperwork. If your lease is for 12 months or less, or if the asset itself is low value, we're talking about a tablet, a phone, maybe a water cooler, you can choose to just treat it as a simple expense, just like the good old days.
So what about the other side of the deal?
What about the lessor, the company that actually owns the asset? Well, for them, the story is very, very different.
And here's the big plot twist. While the lessee's world was turned completely upside down, the lessor's accounting stayed pretty much the same. The people who write the rules felt that the old way already did a good job of showing the economics from the owner's perspective. So lessors still have to classify their leases as either finance or operating using pretty much the same old rules. For them, it was largely business as usual.
Okay, let's bring this all home and talk about the real-world impact. Why did the accounting profession go through all this trouble? What was the point?
Well, the scale is just staggering. I mean, it's hard to even wrap your head around. Overnight, companies in industries like retail, airlines, logistics, their balance sheets just swelled up as all these previously hidden debts finally came into the light. We are talking about an estimated $3 trillion globally.
This chart right here shows the most immediate effect. A company's assets go up because of that new right-of-use asset, and its liabilities go up because of the new lease liability. This gives investors a much more honest picture of the true scale of a company's operations and its debt levels.
But here's a funny consequence, one that might actually surprise you. A really popular performance metric, EBITDA, that's earnings before interest, taxes, depreciation, and amortization, it actually tends to go up under this new standard. Why? Well, think about it. The old rent payment, which was an operating cost, is now gone. It's been replaced by two new expenses, depreciation and interest. And guess what? Two expenses get added back when you calculate EBITDA? Depreciation and interest. It's a huge deal because it can make a company look healthier or less risky by that one specific metric.
But ultimately, what this all comes down to is transparency. Before IFRS 16, the big question for analysts was always if a company had hidden debt, and how much. Now, that information is right there for everyone to see. The conversation has totally shifted. The new question is, okay, we see these massive assets and liabilities. Now, how well is the company actually managing them?
Look, IFRS 16 was a monumental step towards a more honest kind of corporate finance. It really forces us to ask a bigger question. With leases finally brought into the light, what other complicated financial deals are still sitting there in the shadows, just waiting for their own moment of transparency?